Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about mortgage rates heading higher and the possibility that we are looking at a rebound of the savagely unhealthy housing market. Logan, welcome back to the podcast.
It is wonderful to be here. Happy Friday, Sarah. And we are going to be going to New York soon.
It's true. We will be there for the MBA secondary conference. Look forward to seeing lots of friends there. And you say happy Friday, but I got to tell you, the mortgage rate situation right now does not make me happy. Where are we?
Yes, the 10-year yield has recently broken above a little tight range, and it's pushed rates higher, even close to 7%. The spreads are getting a little bit more worse than they have been. So definitely 7% mortgages are back in play again. And the 2023 forecast range was 5.75 to 7.25. We haven't quite gotten to 7.25 yet, but I would say that the banking crisis has changed some things in 2023, and also the debt ceiling issue has also changed something short term. But we did have Jay Powell talk this morning and talking about credit getting tighter really helps them out. I mean, I'm paraphrasing, or I'm putting my own spin on this. Tighter lending standards for the economy can get our job loss recession faster. So we might not need to hike higher than we would have originally, which credit was getting tighter even before the Silicon Valley banking incident, and they still kept on hiking. So remember, focus on the prize. Eye on the prize is a job loss recession, and credit getting tighter actually will help them get to that level.
But we did have some Fed members this week talking about raising rates, even with all this other stuff going on.
Yes, President Logan talked about, it's not completely off the table for hiking in June. So remember, I'm not a Fed pivot person because these people want a job loss recession. They haven't gotten it yet. So if people are surprised that, you still have the president of the Dallas Fed talk about we could get another rate hike, they have known all this information about credit getting tighter for months, and they're still hiking. Why? Because they haven't gotten the honor badge, right? Think of the Federal Reserve members as getting an honor badge that they know when they all die in the afterlife, they will have an honor badge because they all want to be Paul Volcker. And just like, I created a recession. People lost their jobs, but our job is to fight inflation. So there we are, right? And there's their immortality. So if people were shocked that the president of the Dallas Fed talked about rate hikes even the next time, some people would say that's jawboning, but in reality, they've had every chance to talk about things that they talked about toward the end of last year, which were constructive when they said, listen, we don't want to overhike because we don't want to break something and then force us. They don't care, right? They had a banking crisis, they had emergency lending, credit's getting tighter. They're still hiking during that whole process. So eye on the prize. They've said this from the beginning. They want a 4.5 to 4.75% unemployment rate. That's 2.6 million people roughly losing their jobs, and they haven't had it yet. Jobless claims this last week actually fell. So it shouldn't shock anyone that we're still having this discussion almost going into June.
So the top of your range of your 2023 forecast for mortgage rates was 7.25, you said?
7.25, assuming the spreads were bad. But in this case, if we got to 4.25 on the 10-year yield, you're 7.5, 7.75, something to that nature if the spreads get worse. Yeah. So this is why, we talked about this a few podcasts ago. If people say rates are too high, and I talked about, it could be a lot worse, right? If bond yields go up or they go up in that range, you can be easily above 7. We're talking about 6.25 and 6.375 being too high, but considering where we are still in the labor market, it could be worse, and it's gotten worse recently. So I would say that the banking crisis has changed a lot of things this year, and the debt ceiling issue will take care of itself. We're not going to destroy the entire U.S. economy just for politics. So that'll resolve itself. But the banking crisis is or the credit getting tighter. These things are legit and much more sticky than a debt ceiling issue.
You talk about that and we're like, oh no, there's no way we would do that. I listened to a radio show this morning on NPR and they were talking about the fact that their analyst said, if you ever start out saying, well, Congress isn't stupid enough to do X, whatever that is. He was like, then you don't know enough Congress people. He's like, then you haven't been to Congress lately, because even though it's stupid, they might do it.
Let's assume they default on their debt and all hell breaks loose. That would be a day or two, because I would say this: you don't want to be the person in history like that did something this stupid. I mean, it's just I just don't. Politics again is a political theater, but all of these people have constituents in their own states. So if the worst scenario, I mean, they're basically harming their own people. So you could give the kind of the Suicide Squad theory where they don't care, blow everything up. But there's too many normal people still working in Congress to just say, let's just destroy everything. So, I mean, it's just
that is the hope, that there are still some normal people there.
I know what people are thinking. Congress isn't efficient, but this is different. That's why I always say you could possibly have a 1 to 2 day chaos, but I mean, we'll be honest with you here. President Biden can just do things to stop this right away. In fact, a friend of mine who's been working in DC is setting up like multiple ways for the White House if they wanted to. So that's why I don't really think this is a big deal, because there are levers to pull to prevent something like this. So they're going to play it up to the very last minute. And worst case scenario, you have 1 to 2 days. But the United States, the White House can do this. They can prevent the default. So that's why I'm not putting much into it outside of 1 or 2 days. So that's my best advice to everybody. Don't think this is the beginning of the collapse. I know there's certain people who love gold would love to see this, but it's not. The White House has all the chips if they really wanted to. So it's just how you want to resolve this situation.
So we have until June 1st for that to get resolved, and or a couple days afterwards, as you say. So mortgage rates might be going up until then, you think?
Well, the 10-year yield fell today. Short-term rates have been rising. The 1 month bond yields had a really crazy last 6 weeks. But again, when I think of 2023, the 10-year yield is doing exactly what I thought it would do. So for me, it's not anything out of norm, but except the short term, we've broken above a little range, and that's pushed up rates. And again, to me, I think the banking crisis itself is more important, because that has been sticky. The spreads were getting a little bit better before the banking crisis happened, and after that, it hasn't. So I would put more weight on the banking crisis and the credit getting tighter than the debt default, because the White House has levers to pull, and they'll pull it, right? If need be. So I just wouldn't put much value on the debt default and the collapse of the economy or anything like that.
So I hate to be a Debbie Downer. I like to be positive. I like to focus on the positive. But today I do have to ask you, when the existing home sales report came out, you wrote a story about, are we seeing the unhealthy housing market coming back, the savagely unhealthy housing market coming back? What prompted that?
For me, I'm just being consistent with what I've talked about. I'm a days on market person, and days on market, being in a teenager or under is never a good thing. I've always stressed this. That was the creation of the savagely unhealthy housing market came on February of 2022, because days on market were too low. Multiple bid percentages. Actually, I think we got up to the craziest stat is we like 75% of the market in early 2022 had multiple bids. That is not a good thing. That is not a good thing. So It was after March, even after the Fed said we need a housing reset, that rates started to go up. But rates are still high. We're here, and the days on market, I think, as high as like 34 to 37 days. I'm using the NAR data. And now it's fallen back down to 22 days. And again, the story here is the total active listings is just simply too low if demand is stable. And I think that's the big theme of my work. Since November 9th, when rates started to fall and purchase application data got better, demand has stabilized. And I'm not a big sales rebound person, as I noted in the article, but with demand being stable, we've seen this, the facilitation of days on market to come down because there's just not enough product. And looking at the Altos inventory data by Monday morning, by Sunday night we'll have the updated one. I mean, year to date inventory is still negative. We're not getting much traction. I mean, if we took 2022 out of the historical data lines, we're like at all-time lows. So it's again, supply and demand economics. When home sales were crashing last year, it facilitated days on market to grow, but the inventory levels are still very low. And now that demand is stabilized, we've seen the days on market fall. So that's the unhealthy housing market in 2021 becoming the savagely unhealthy housing market in 2022. It's not because home prices are up 10%, 15% like they were. It's just choices, right? When you don't have choices, whatever's left is the hungry hippo game. Here, you don't have, the 15 to 20% year over year gains, but price gains, but you do have a marketplace that simply doesn't have enough products. And in certain areas of the US, too many people chasing too few goods, right? And that in itself is inflationary because it just keeps prices stable or higher in this context, which I'm not a big fan of. I haven't been a fan of since my model broke, but this is the reality of the world we live in.
So that was existing home sales. What about new home sales? Are they going to come into the rescue?
We always have this debate on Wall Street. Lumber prices are crashing, so the builders should be crashing the exact opposites, like an alligator chart. The builder stocks are at 52-week highs, and lumber is still depressed. And I just, I'm trying to explain this to traders that you're focusing on different dynamics with lumber prices falling, right? So there hasn't been a time ever recorded in history that total active listings are this low. So when people, like a lot of people like to show these, builder confidence charts that were like, oh, they had a slight bump in 2007. No, that's not where. See, Sarah, this has become a problem. Not reading is really hurt some people. And I highlighted this in a video on Twitter that in 2005 to 2007, we had an 82% crash in new home sales. During that period, their total listings or completed sales went from 80,000 to near 200,000. We're at 71,000 right now, and the completed homes available for sale. The builders' cancellation rates are falling. It was rising back then. The builders' monthly supplies are falling. It was rising back then. Home sales were still crashing back then. Home sales have stabilized. So if you're using a piece of wood, lumber, what is that? What does lumber mean to builders? It's an input cost, right? So now you're saying a lower input cost while demand is stable and cancellation rates are falling is 2007. I mean, I could get a second grader and they would understand. No, that's not a lower input cost means they have more margins, means the builders can push down rates. They can move their products. They front loaded a commodity and they didn't read about everything else. And that's the problem of not reading. When you don't read, you simply don't know that active listings are low and the builders are buying down. You just assume that one commodity controls the entire supply and demand demographic. That's just not how it works. So new home sales are just stabilizing. They're moving products, they're buying down rates. So their sales are in theory doing much better. than the existing home sales. The existing home sales market has much different dynamics, the seller, buyer backdrop versus a business that sells a home like a commodity.
This is Sarah Wheeler, Editor-in-Chief at HW Media, talking with Christina Bennett, Senior Vice President of UWM Sales, about a career in the wholesale channel. Christina, what have you seen happen in the wholesale channel over the past 6 months?
Yes, Sarah, we've seen some great growth in the wholesale channel over the past several months. Specifically, every single week, we're getting hundreds of phone calls from retail loan officers calling in to find out how can they join an independent mortgage broker? How can they become an independent mortgage broker? And quite honestly, just realizing that wholesale is better for consumers and a better place for them to work as well.
Thanks, Christina. And listeners, you can go to beamortgagebroker.com to get more information. So with rising mortgage rates, as we see right now, that's what we saw last year with builder cancellations, right? Cancellations of contracts and things that were under. But I do think the difference now is that buyers know what they're getting into. I mean, they're not expecting 5%, it goes to 7%. I mean, even if it goes a little bit higher, they know what they're getting into now.
They know the pocket size, but also the builders are just they're playing with different rules than the existing homes buyers. So imagine if the 10-year yield is at 2.75 and the mortgage spreads are normal. We have a high 4%, low 5% marketplace. That's what the builders are dealing with. They have the ability to bring rates lower. So give them credit. They're taking such advantage of this marketplace, and they have their backlog and they're moving through it. They're efficient sellers. So I think a lot of people just didn't understand how the business model works for the builder. So at first it was a shock. They had high cancellation rates, but they don't want their products to start building up, because imagine all of a sudden everyone needing a price cut. They're seeing the next person, they need to move products. So they'll pull levers to do so. That's why I always say they are efficient sellers. And because they're efficient sellers, they pull the levers needed to move product. And that's it. And again, same thing as always, sale levels are historically low. Last year, if you looked at the sales adjusted to the cancellation rates, were like near 4 or 5 decade lows. So they're not working from a very high bar. And I think that's in general, that's the biggest thing about housing that nobody wants to talk about. Home sales are already low. They're historically low. People think, okay, they're going to crash. Okay, then say it. 6.5 to 4 million, 4 million to 1 million home sales. Not that hard. Just go ahead and make that premise. Or new home sales, they went down to 530,000. They're going to go to 100,000. But if you're not going to say that and you're wondering, like, why aren't home sales even going lower? It's stabilizing itself. So,
you and I often go on rants about people on social media, but I've seen some more rounds of like, I'm driving through builders' developments and it seems like it's stalled and there's like nobody here and it's like a ghost town. And it's like, I've lived for the last couple of years in new build environments and I see nothing like that. I mean, things are clipping along. I'm sure maybe the builders wish they were more, but when you have so little inventory, and they've been so careful, they are insulated in many ways from what these people seemingly think is going on.
I've always said this. If anybody talks about housing and they don't forecast anything, don't listen to them. Like 99% of the things I see are lies and like crazy stuff. What I call the Zillow snapshot, like what happens every single year is that the seasonal price declines that you see, even if prices are up, everybody for 12 years kept on snapping Zillow shots. So look at this. Or they're reducing their prices, not realizing that 1/3 of all homes in America have a price reduction. That's very normal. Again, to make it very simple, if men and women don't want to put their names and face and forecast on anything, you shouldn't listen to them, right? Because that's what I see. That's why I challenge everyone. I would take every single man and woman on planet Earth, get them in front of a camera, get their forecast, and then let's talk about economics. And 99.9% of them will never do it. They have done exactly what I've thought they would do. They would show the American people that they don't forecast housing. So don't listen to people who don't forecast. So the builders shown this. We wrote that article about how Wall Street was wrong, how a lot of people were wrong because they didn't understand the business model. So if you don't understand the business model, you're just making stuff up. I take a picture here, picture there, and it's just not the case. So, but at least I know this. People lost money doing this. shorting the builder stocks. I had people like show me pictures of their short builder trades, and I go, good luck. Good man. You believe in your premise. So at least it stings a little bit, but for everyone else, just follow the housing data. This is why we do the tracker. The tracker and all these articles are here to show you. So the structural dynamics of housing are different now because home sales are already low. Inventory is already low. So those are two things we know that are true. Those are facts that you can't change that. So you just work off of the supply and demand economics of that for the builders, which is different than the existing home sales market. And I just think there's so much confusion because when you have people who aren't trained to talk about data, boy, they take it to some crazy place. And in this context, I think people just didn't understand how the builders do their business. And if we had 2, 3, 4 million active listings, none of this will be happening, right? Too much supply for the builders to compete with. They'd have to cut prices even more. And, housing permits would keep on falling more and more and more. But we don't have that environment at this stage. You would need rates to go higher and demand to really start falling again. And then you have a working premise there, right? That's what I said. If home sales were still crashing like they were last year, you have a different ballgame. That hasn't happened since November 9th, 2022.
So pivoting a little bit from the housing market, right, into the larger economic picture, we had the leading economic indicator report come out. Tell us, are we headed into a recession? What did it tell us?
So it's interesting. If you look at the leading economic index from the Conference Board, it's deeply showing very late economic expansion data lines. That means that the recession should be coming very shortly. Again, for myself, I was able to go in front of the Conference Board last July 27th, 2022, and present my 6 recession red flag model. So now that we are here today, I think this is a good going back to that article. My recession red flag model is a progression model. It's stages. The time to look for recessionary data is when all 6 flags are up. So here we are. What are 2 things that could help the U.S. economy? Number 1, the growth rate of inflation could fall. That happened. Number 2, bond yields could fall. That could help housing. That happened, right? The second one was that the Fed would stop hiking rates and then cut eventually. That hasn't happened yet. The labor dynamics, the balance sheets of America are much different now than previous. So we're just looking to see when does jobless claims break. And as long as people are spending and employed, you need some kind of exogenous shock. Now, last year you had higher oil prices, higher gas prices. That has come down. Okay. There was a worry about Europe not even surviving a winter. That has been taken off. So there are other dynamics that are helping keeping this expansion going. But again, demographics are good, balance sheets are good. When I talk about balance sheets, what does that mean? All the Americans that bought homes from 2012 to 2019, what did they had? They had a fixed debt cost, rising wages. Their total housing cost is so low. Then COVID happened, right? And then guess what? A lot of people refinanced. So they got even lower payments. Their cash flow even got better, but their wages grew faster. Right. So people are like, how are people spending? Inflation rates? Well, if you look at it in that, those households are kind of are insulated from the massive rate hikes, massive higher mortgage rates, and massive inflation. So if you look at it in that way, you can see that they're doing better. The one thing that has happened for them is that their wages have gone up. So we're just looking to see when does the labor market break at this point? And the last time I had all 6 of my recession red flags up was late 2006. The recession didn't happen until 2008. And back then we had real major deterioration of credit. People were filing for foreclosures, bankruptcies, 5, 6, 7, and 8. And then it took some time for that to break into the system. So you want to be mindful of this. But yeah, everybody who looks at the leading economic index, they're like, whoa, that looks recessionary. So we're waiting to see the final data line, and that's just jobless claims. And always take jobless claims over job openings.
And you've been saying this for a while. I mean, you had your 6th recession red flag raised in the summer, correct?
August 5th, 2022.
August 5th. Thank you. Ready with the reference there. And you said at that time, the thing you have to look at is the jobless claims, but definitely other things are lining up now to where it feels like that. Does anything, when you look at, does your six recession red flag model, does any part of that tell you how deep the recession is going to be, how long it's going to be?
Well, right now, because credit standards are normal, and this is a longer term discussion. I think what happened was people never understood how important it was to have the 2005 bankruptcy reform laws and the 2010 QM laws. Like, if I was presenting to all of Wall Street, I would say, have all your analysts go back and look at those and look how consumer consumption, because really we're a domestic economy. Like, our economy revolves around our spending in home. We're not necessarily living off exporting stuff like other countries do. So we had the longest economic and job expansion ever recorded in history after those two laws were put in. We had a very brief recession for like 6 weeks during COVID. We wrote the recovery model on April 7th, 2020. And again, this rebound, especially for the labor market, has been really good, because you would need the shocks from the banking crisis. That's going to impact some local economies. When the commercial loans start to go bust, some of those companies will get impacted. But you just got to really look at spending, and what eventually happens is higher interest rates, higher interest costs, credit getting tighter. Those eventually become big enough to create a job loss. I can make a case that California is in a recession right now. Their unemployment rate has gone up 0.5% from the lows. In theory, it's, the Claudia Shaw rule, where if the unemployment rate jumps up 0.5% from the lows, your economy is in a recession. Okay, so you start looking at things like that, and you start to see a few cracks in there. But until jobless claims break over 323,000 on the 4-week moving average, the general U.S. economy is not having what we call a job loss recession, where we have a lot of months where you start to see 200 or 300,000 jobs lost. The one thing I would say about the size of this, whenever the recession happens, again, we have levers to pull to really plug in the holes in any recession. The question is, does the Federal Reserve, how they act during a recession? I think that's where I'd like the conversations to start to go, because they're whether they hike another quarter or not, it's just they're almost done. So it's really depending on what they do after, what the government does after, or what business can do after on that. But one thing we know for sure, the fact that the baby boomers have been leaving the marketplace, retiring, our replacement workers' unemployment rates are low. That dynamic doesn't change. The baby boomers don't get younger, right? Every year, more of them leave the workforce. So we just, this is the whole job openings, 10 million, right? The whole premise of us getting that high was that the labor dynamics are different now than they were, let's say, in 2008.
Okay, I still have not forgotten that you called me a boomer. So we're going to put a pin in that. You've repented since then, but I'm not forgetting that.
Sarah, there was a really good joke that I did on social media where there's all these people that tell me, like, oh my God, nobody understands. All these baby boomers are going to die and they're going to flood the market. Why are people so ignorant? So then I said, okay, and I think this is a good lesson for everyone. This is what I would tell real estate agents and mortgage people to tell their clients or everyone else. Could you imagine you being a 29-year-old guy? You just got married, right? And your wife and you're planning on having kids, and you tell your wife, honey, the baby boomers are going to die. And when they die in 2035, they're going to flood the market with homes. And then we're going to get a deal, honey. We'll just sit and wait. And that conversation isn't happening, because older Americans, baby boomers, you're not a baby boomer, you're a Gen Xer, have this fascination with death and the silver tsunami and inventory, right? And this is what we call the silver tsunami. I've been dealing with the silver tsunami for, God, what's it now? It's year 8, 26 to 30 million homes coming to the market starting in 2015. That didn't work well. So younger people don't think like older people. When younger people have sex, they have kids. So it's a whole different thing, right? Older people are just grumpy And they're like, oh yeah, these stupid kids don't realize we're all going to die and flood the house. People don't think that way. Young people don't think that way. They're not sitting there thinking, oh, if I just wait 15 years, like I did. People live their lives. They're happy people. They live their lives, right? You baby boomers, let it go, right? Just sail off. Sail off. It's the end, right? Just go gracefully, right? You don't have to start yelling at these people are stupid. Don't they realize we're all going to know? Nobody cares. So in that context of the conversation, starts to, you start to go in a really weird place. And, talking about the NAR inventory, the NAR inventory is a little bit different than everyone else's. They capture these pending sales and they have everything in. So naturally their number is higher, but the year over year inventory increased. It went from like 1,030,000 to 1,040,000. That was it. Right. And we just had the biggest collapse. And the silver tsunami was supposed to happen in 2015. That's when every baby boomer was 62 in 2008. And then starting from 2015 to 2025 was going to be the 10-year decade that all of them were going to sell their homes at once. And who knows what they were going to do, where they're going to live after that. That was the funny part. And then no millennials could buy them. So home prices have to come down 70% just so they can, and then they lose their equity and then they can't buy. It was really some crazy stuff, but we're here today. It's 2023. We're almost in June. We are almost in June, people. Guess what? Inventory year to date is negative still, right? We had those new listings are trending at all-time lows. We're sitting here, and like I talked about, we had 1 week last year that has more inventory growth than the entire year this year. So much different dynamics. And what I would say is that you got to be careful with the baby boomer stuff and, worried about young people. Young people just think differently.
And we are grateful for that. Wish we had better news on our Friday. We will, by the time this airs, we will have our housing market tracker and we'll know what inventory looks like. So listeners, go check that out. And Logan, thank you so much.
Pleasure as always, Sarah.